Welcome to the Family Office Sherpa podcast. I'm your host, Shaun Parkin, founder and managing director of Hall Road Investments. The aim of this podcast is to provide practical and implementable advice for those looking to build, manage, or service a family office. This is not, however, investment advice, so please check the disclaimer in the show notes. In this episode, I'm talking about the 7 founder office investment traps and how to avoid them.
This is the Family Office Sherpa.
So, what does that mean? Well, I was listening to the book by Adam Grant called Originals, which I recommend if you've got the chance to listen or read it. And really what it's about, there was a story in there about Steve Jobs and how he famously believed that the Segway would change cities and human transport and all the rest of it. You know, that founder intuition, if you will, it had elite belief. He wasn't the only one. It had genius level confidence, and it's still, the Segway, despite sort of seeing them every once in a while, it hasn't exactly changed cities and human transport, right? So what I thought was, it's actually a really good reminder that even brilliant operators and founders and people that have just done extremely well and had liquidity events, and that's what you do see in family offices quite a lot, can misread outcomes a lot of the time in unfamiliar domains. And why I bring this up is because unfamiliar domains for a lot of people is portfolio management, is investment management, as opposed to building a business, as opposed to finding a niche or finding white space or whatever you want to call it. This is where the difference lies. So what I thought was, this might be a good opportunity to think about what I see and what you do hear about, which is this post-liquidity reality for founders when they set up their single family office and they remain highly engaged, and investing becomes, it almost replaces that business builder. But what I would like to go through the 7 kind of traps is maybe a little bit melodramatic, but those biases that can affect the way that it's invested, and how, 7 versions of that, and how we can alleviate or how we can, circumvent them. So that's what we're going to go through. I'm going to go through the 7, and then I'm going to go through the ways that I've seen it effectively managed. Okay. So number 1 of the 7 founder traps, domain transfer illusion, which means I succeeded in business here, so I'll succeed in investing here because I'm good at that, therefore I'm good at this. There is some skill set overlap, but it is often less than most people think, a lot less in some cases. And there's a sort of a term that you kind of hear, which is that investing, punishes, operating rewards certainty, right? Operating a business and having certainty is rewarded. With investing, if you're certain of something, if you believe that you know something that no one else does, and, it's famous, investing is famous for the fact that no one really can predict the future, despite what people say. There's too many factors involved. There's too many moving parts. And so investing, to be certain of outcomes in investing is often a fool's errand and can get you into serious trouble. But when you're an operating business and you know what you're doing is the right thing, then certainty can be a really big positive. So what I'm trying to get to there is that there is the different ways of looking at things, and investing, unfortunately, to a certain degree, kind of punishes certainty. Number 2, they don't seek external expertise, even when unclear. Founders often assume that they can figure it out because that's what they did in business. It's what, I run a business and I'm still kind of figuring stuff out, but I believe, I have confidence that I can. But when it comes to investing, often you find founders that would maybe distrust advisors because, and this is not all advisors, obviously, but when you first have a liquidity event, the amount of people that come at you, and if you're not used to that and you don't have a good gate or and I'm not talking sort of, some version of a gatekeeper, but certainly a filter, or certainly a version of saying, well, this is what we want, this is what we don't want. That can be really, really challenging. And often you find that people that go with the first advisor, or someone knows someone that knows someone, and they have a bad experience. And then you find a lot of founders who go, well, they're all charlatans. They're all thieves. They're all, there is an element of just broad stroke, right? And then what happens then is they go, I'm going to have to do it myself. And because I can trust myself, or I can trust my consigliere, or someone that came over from the operating business, right? So that's where we find that it can cause some issues. They often distrust advisors because many are what you probably call product driven, and speak in a language which is full of jargon and makes things opaque and uncertain, and that doesn't help anyone's cause. So what they do is they delay getting help until often after the first big mistake, or multiple small mistakes, or whatever it ends up being. But they definitely see, like, they're not going to look for external expertise because we can do this ourselves. Number 3, there's this idea of misapplied intuition. Now, these people's intuition is real because they built something, they sold something, they were very successful. They built it for a specific operating environment. But intuition, there's an element of I don't know, the recognition of patterns is not the same as investing insights, right? They often underestimate how much markets are driven by, let's face it, randomness and cycles. And so when they apply their intuition for this means that, when it comes to investments, which can be super random and don't make sense, and hang on, that person said that this currency would do this at this time and it doesn't. It's like, do they know what they're talking about? This element of randomness and cycles can be really confusing and, to be honest, frustrating. Number 4, they tend to fall in this idea of trust-based investing, which is that they invest based on, like, as it is, on trust, on the person, on the pitch, or the relationship, right? They don't look past that. They go, this person gave me the deal, or this person has recommended this, therefore that must be good, or that must be the good way to go. They overweight things like charisma and underweight things that are a little bit more boring, or a little bit less, or a little bit more process driven, such as structure. I find that they can be a little bit challenged by being able to separate the person, or I like this person, from this is a good deal. And not to say this is always the case, but you kind of do see that a little bit more because, to be honest, a lot of the time businesses are built off these kinds of things, right? You work with people you like, you build businesses with the people you like. One of the prerequisites to a certain degree of a good salesperson is that they're likable, and you like going to lunch with them, and you like getting tickets to the footy or whatever. But don't think that necessarily means therefore this is a good deal and they have our family's interests at heart. Okay. Number 5, they miss red flags. Red flags can sometimes be missed because the story feels really compelling, right? The narrative feels really compelling, and therefore and because, in particular, things like, I don't know, like private equity and venture capital and things like that, which is, they're great narratives, they're great stories. It's about the future. It's about changing things. It's this person's going to be the next. We talk about like Steve Jobs or whatever, but storytelling is not the same as managing an investment portfolio. There's also, what we often see is this idea of being early, and the excitement of being early and picking a winner or picking a manager or picking the trade or investment or whatever can override some of the skepticism that should be, to be honest, a little bit more front and center. You also find with this missing red flags piece is that dissent gets filtered out because it's not necessarily because they only want to hear yes, but it gets filtered out because the founder is often used to being right. So it's can you imagine telling Steve Jobs, no, that's a terrible investment? And you go, well, hang on, he's Steve Jobs, right? He built this, he's done this. It's a real barrier. It's a psychological barrier, but it's also a barrier to people voicing dissent. Now, also, the other thing when I talk about that sort of process piece is investment governance, which is obviously my kind of thing, such as the investment committee, the investment policy process, etc., can be superseded by the founder's decision, and that's across. That's just how it is. That's just how family office is. But if there's no process around there, a lot of the time those missing red flags. So part of my job a lot of the time on the investment committee with founders is to say, hang on a second, I don't see it's a bad investment, but maybe let's look under the hood. Let's look at what this exit is a really long one, or this doesn't look like it says it does on the tin. So, just having that extra bit of governance and investment policy can be superseded often by the decision. Number 6, there is an element of ignoring bad investments, right? When I say ignoring, they've been made and then we don't talk about them again. So like bad investments get written off, like emotionally parked, right? Which is not, now we don't talk about that or whatever. You do see that within founders a lot because, like I said, they like a story, they like a narrative, they like a person, they like being first and things like that. When it doesn't work out, you often see that getting put in the bottom drawer. And there's no review process of that investment. So part of, sometimes my job is to clean up portfolios, not necessarily because I'm the investment manager. It's more we've decided that all these, I don't know, as an example, single stock or speculative stocks or whatever don't fit the investment policy anymore. And so therefore the office needs to remove them, right? And sometimes they avoid being removed emotionally, but this is emotional, this is actually cleaning up portfolios. So this lack of review process, there's no learning loop. I don't want to see that bit of red ever again in the reporting can happen, right? So they lose the chance, I guess, to a certain degree to improve the decision quality over time because they don't want to think about it. Number 7, there tends to be a narrow breadth of portfolio, let's call it concentration, right? You often hear about it, especially those that made money from certain types of industries. They'll be overweight that, property, investing in venture capital, private equity, things like that. That often happens. And again, it's your money. You can do what you want, right? But founders build wealth in a sector, country, or asset class, and they tend to, by the nature, which makes sense because this is what they know, which is what they come from, overweight those significantly. So they naturally keep overweighting what you know. And a real portfolio needs breadth. Well, does it need breadth? It does. Again, if the investment policy and the purpose is around long-term capital growth and diversification, stuff like that, it's hard to argue for an 80% allocation to venture capital or something like that, or an 80% allocation to direct property when you're saying these things. So I find that with founders in particular, or even just officers that have made their wealth and, grandpa or great-grandpa or grandma made their wealth from that, there tends to be a bias towards that. But, sometimes there's a reason for that. Okay, so that's the 7 sort of traps or whatever you want to call them that I've seen with founders. Let's think about the 5 ways that founders can, alleviate that or benefit from some expertise, right? So number 1, find aligned advisors, not people that are going to product push. Look for advisors who are paid for advice, not for selling something. So look at things like transactions, commissions, placement fees, all that kind of cool stuff that's good revenue, but obviously places them on the sales side. Find people that can say no without fear. Advisors that are, you see these sort of multifamily offices or smaller boutique firms that can go, we know our clients, we love our clients, these are the clients we have, we discriminate on having more clients. We're not looking to, boil the ocean here. We're just trying to build a really good business of aligned clients. And you'll find that those are the ones who will say, well, this is our fee and this is all you pay. You pay us this. Everything else is, we don't take commissions, we don't change transactions, stuff like that. The right advisor, aligned advisor, can protect you from your own overconfidence. They can, as long as you're open to it, they can be really, really helpful in terms of not creating this echo chamber. Number 2, on that point, build diversity of opinion, right? Diversify opinion. Surround yourself with people who can challenge your assumptions. And, and you might not like it, but maybe encourage the ability to disagree before the money moves. Why, even if it's just a sort of devil's advocate type of why wouldn't this work? Tell me why this doesn't work. Or are we thinking about things? This is why advice can be really helpful, because they can give you alternative viewpoints. They might be paying for, or you might pay for your own research or whatever it is. Sometimes, a lot of investments, I really like having third-party research on it, not just internal, because it gives that diversity of opinion. It makes us think about something. This is why strategists are really good. This is why talking to wealth managers generally is really, really good, because it can challenge some of those thoughts, right? You kind of want tension in the room before the decision's made, not after. And that's, you can draw your own sort of conclusions on that. Number 3, get outside the bubble. Spend time with other family offices in particular, compare approaches, learn from other people's scars and mistakes, especially if you're looking at investments, get some people that have been with firms before. You don't want to, the risk of normalizing bad habits can be really, really challenging in this founders kind of space. So, really sort of get out there, talk to people. Even if you're not going to, there's a lot of people saying, well, we don't want to talk to this private bank or this wealth manager or this asset manager because now they're going to start trying to sell us stuff. And to a certain degree, you're right. But also, you do need to diversify or talk. If it's a global investment bank or private bank or asset manager, they're going to have access to information, access to research that you're not going to. So to just close yourself off because you're like, I don't want to get sold to, that can be, shooting yourself in the foot a little bit. Right. Number 4, decide whether you actually want to do this yourself. Because, like I said, founders are really, really good at building businesses. And this is another business to a certain degree, right? But this is an asset management business. This isn't selling a particular item. It's not building a property development business. It's not that kind of thing. So you have to decide if this is actually what you want to do, because being head of investments is a job. It's not a hobby, right? And you're doing yourself a disservice, and if you're looking to pass on through the generation, you see yourself as a steward of these assets, then you're doing future generations a disservice too. If you are not taking it seriously, well, not that you're not taking it seriously, but you're not using all these things that that you can access. Also, you may want to stay as chair or allocator or be involved, but just not to the day-to-day investing piece. And that's fine. And you do see a lot of that, and that works really well, which is the founder's gone, I'm going to step back to a certain degree, and I'm going to have a monthly meeting or the quarterly meeting or whatever it ends up being. And I'm going to have my own dashboard, and I'm going to have my own information. So I'm going to be aware of what's happening. But on the day-to-day piece, I'm going to leave that for people that I can delegate and I can trust. Because, like I said, clarity here prevents a significant amount of issues down the track. And number 5, build a process and build governance. So what we're looking for here is, to a certain degree, filters. We're not looking to add bureaucracy. Founders hate bureaucracy. In my experience anyway, there's not a lot of appetite for saying, let's go through another a few white papers and we want to do all this before we can make a decision. That's not what I'm talking about. I'm talking about establishing an investment committee that is relevant for the purpose here and can be followed without stifling interest and, more importantly, stifling the internal skill set that founders and entrepreneurs bring to these sorts of things. Simple decision filters, over gut feel. Simple decision filters beat gut feel over time, right? So just having that really easy to use, easy to implement decision filter. Governance, in my opinion anyway, makes outcomes reviewable or, pragmatic. those sorts of terms, not emotional decisions. It preserves the strengths that we're looking for, but, hopefully what it does is it reduces those blind spots. So how should we close on this? How should we reflect on it, right? So there's three, I guess, questions that you could ask yourself. If you're a founder or you're working for a founder or whatever, there's a founder's office and you call it that, or you can call it the portfolio, or, there's still an operating business or whatever it ends up being. So maybe three questions, right? Number one, where am I assuming that my skills transfer, and where don't they? So they might not, my skills might not exist in this asset management style business. And you have to have a bit of self-reflection there. Another one is, who is allowed to disagree with me? And do they actually use that permission to disagree? So, which is what we're trying to avoid here. This idea of just continuing with bad decision and no one saying anything, and that there's no feedback. And the third one, what decisions have I put in the drawer and forgotten about, instead of reviewing and being thoughtful around sort of what the portfolio actually looks like? So maybe there are three questions to ask. If you're interested in understanding how I work with founders' offices, because honestly, it's one of my favorite things to do, feel free to email me, Shaun, SHAUN, @hallroad.com.au, or message me on LinkedIn. I'm always there. If you like this content, you can also subscribe to the Sherpa newsletter, which has been going for 7 years and continues to add readers, and it's a nice, engaged newsletter there. And that can be found at wholesale.com.au. If you're enjoying the podcast, please ding the little alert bell, maybe give it a rating. That's always super helpful. Please visit the Sherpa website, familyofficersherpa.com, where you'll see the podcast, newsletter, guides, and videos. Until next time, thanks for listening.